So we're going to talk about financial statements, basic financial statements. And again, please print out this and record it as we go along. Then use it to record other things from your chapter or do it someplace else. But anyway, notes are incredibly important. Studies have shown you remember things better by engaging more of your senses. And so writing them out is certainly useful to you. Again, please look through the study objectives. Actually, look through the study objectives both before and after this video or before and after this chapter just to see that you have everything. And I've included the discussion questions on this and again the solutions for the discussion questions at their end. So you can email me and ask me about those type of things or ask me in another setting. Okay, so we're going to talk about basic financial statements here. And so first thing that we're going to do is make some notes on those, but we're going to talk about those just briefly. Basically, the financial statements are how we summarize things and give them to investors and creditors. So it's sort of like they're an executive summary. We don't want the details on every revenue that we made. Sometimes we want revenue broken out in different areas if you have some major revenue sources, but for the most part, we don't care that you sold something to me today or even the amount of sales that you had today. We want those accumulated and summarized, just like you would do on your tax return. You would put the amount of your W-2 or the amount that you made in a business for that year, and they don't ask for details. So what has happened over time is creditors and investors have indicated some breakout of some items that they want. So for instance, they just don't want one line net income. They want breakout of revenues and sometimes specific revenues that you would have, etc. So you can read through those. But the three primary financial statements are the balance sheet. I've had students who kind of are sometimes confused when they change a name. It doesn't have to be called the balance sheet. It can be called the statement of financial position, the balance sheet. This one is important because it's a snapshot at a period of time. So look at the name and see if it says, okay, what do I have and what do I owe at this particular point in time? The income statement is how much I made during the year, and the statement of cash flows, we'll talk about those. So it's as of a specific date. I talked in the last video that if let's say we start business on January 1st and we did a balance sheet, our balance sheet would probably be full of zeros on January 1st. And then at the end of the year, I do another balance sheet of 12/31. So the balance sheet is what I have on that specific date. So I started out with 0, and then at the end of the year, I had $10,000 in cash, some land, buildings, etc., etc. So the question is, how did I get from 0 to having all of those items of assets, etc.? Well, what happens is we do an income statement that kind of bridges the gap for how we got from this point to this point. Okay? So the balance sheet is as a specific date. So you'll see the heading of a balance sheet only has a specific date on it, and it's a snapshot. And when we get to some weaknesses in the financial statement, you'll see that this can be a weakness because certainly many people will say, well, tomorrow I'm going to have an influx of cash, so tomorrow I look better. But we have to pick a day and we have to go with it. I cannot advance the slides with those on. Okay, income statement. Income statement, make sure you know you have revenues and expenses. That's very important. Again, I've had some students that don't know revenues and expenses go on an income statement. And I'd like to remind them that you've been doing this probably your whole life, that if you've ever had a fundraiser where you're going to sell t-shirts or pizzas and you bought the t-shirts for $5 and you sold them for $8, you know that your revenues were $8 and they cost you $5, so you made $3 on each. That's revenues minus expenses. And I think we basically have a great understanding of revenues and expenses, and sometimes throw it in an accounting class and forget some things that are pretty much common sense for us all along. So revenues are what we're in business for. So if I'm here for mowing yards, mowing the yard and somebody paying me is my revenue. Expenses are costs of gaining those revenues. So for instance, if I have to buy gas for my lawnmower, that's an expense. If I have to buy other supplies or travel or actually gasoline for my car to travel to my truck, to pull my lawnmower where I'm going, that's an expense. So costs of gaining the revenues are expenses. Cash flow statement, it just tells us where cash comes from and where cash goes to. And sometimes a business can have lots of revenues and expenses but be short in cash, and so that's the important part of this. So just take whatever notes you need, but notice this is what a financial statement, or a balance sheet, I should say, statement of financial position, I usually call it a balance sheet. So notice it's position as of December 31st. This is my financial position, things I have as of December 31st. So we list them. I think it's kind of showing off the side there. To show on the screen a little better. But notice that we have the name of the company, the name of the statement, so you might have balance sheet here, a statement of financial position, and the date that it is as of. So it's on December 31st what I have. So on December 31st I have these assets, we'll talk about assets later, and these liabilities and owner's equity. And the reason they call it a balance sheet is your assets have to equal your liabilities and owner's equity. So sometimes you can think of it like this. I have a car, and that car is worth $1,000. Not a very nice car there. And those are my assets. And on this side, I have liabilities and owner's equity. Not sure why my computer is not working well for me. But basically, I tell where that car comes from. So if I had to borrow from the bank all $1,000, it would be my assets equal my liabilities. So I have a car, but it came from the bank. Or if I bought it myself, the $1,000 would be over here. So I have a car and I put it in, it all came from me. And you can have a combination. So I could borrow $400 of it and $600 I put in myself. So notice that here's my assets and here's the claims to those assets. So in this particular case, I have assets of $300,000. Creditors have claims to $80,000, and my owner's equity is $150 plus 70. See, my computer is acting up. Of $220,000 from that. So some features of the balance sheet, we talked about this. Assets are generally listed in the order of liquidity, which means how quickly they can be turned into cash. So cash is obviously first. Generally speaking, we don't get too upset about getting them out of order. And then there's some that you don't know which one is more liquid, but certainly cash always comes first. Liabilities are generally on the other side of the balance sheet. You don't have to have them side by side. You can have the assets up here and then liabilities and owner's equity down there, but they do have to balance. And owner's equity can come from two sources. Either capital stock. So this is basically, if I want to start a business, there's two ways my business can get cash or capital. I can put it in, so I invest $1,000 into the business, so that's capital stock. And then the business can make money, and that money is mine. So we like to separate owner's investments from the money that the business has made. Not sure why this is not working. Okay, so we're going to come back to these later. I put them up here. Mainly because I wanted to keep them near the financial statements. But the business entity concept basically says the business is separate from its owners. So I don't want to commingle my funds or commingle my accounting records of my business and myself. So if I put money into the business, even though I own the business and it's mine technically because I own the business, so the cash I put in the business is mine. For accounting purposes, we treat it separate. So the business has $1,000 cash, and I have owner's equity or claim to the business. So I want to keep the records of the business separate from the owners. So assets, you'll see why I kind of separated these out on your handout, because assets, liabilities, and owner's equity need to go in the same place, and then all these concepts and principles. So assets, a lot of people say these are things that I have in the business or things that I own. I like to define them as things that have current or future benefit to the business. So it doesn't always have to be a current benefit. So you're going to see that accounts receivable is an asset. So if I sell something and somebody is going to pay me later, that's an accounts receivable. They didn't give me the cash, but it's a future benefit. So I like to call assets current or future benefits of the business. But notice they're usually economic resources. They're owned by the business. This one, actually, some leased items can be assets, etc. Anyway, so that's the definition of an asset. So cash, accounts receivable, any investments that we may own, our buildings, our land, etc. Those are all assets. Now back down here, cost principle means we record assets at historical cost. I'm not sure why it is flipping back and forth to things. So the historical cost is what we keep assets at. There are some things that we do revalue to current value, such as marketable securities, which would be stocks and bonds that we own that are traded. But a lot of assets we keep them at historical cost. So if I buy a piece of land for $10,000, it's on my books for $10,000, regardless of what it's worth now today. The building, also, it's worth what I paid for it, plus any improvements that I made to it. Other things are recorded at net realizable value, which basically means that the amount of cash I'm going to get from them. So for instance, accounts receivable, some people aren't going to pay, so I have to make estimates on how much they're not going to pay. So if I have $1,000 of accounts receivable, but I don't think 100 will pay, they're valued at net realizable value, or the 900. Fair value is when I adjust them to their market value. So any stock that's actively traded, I record it at fair value. That's the cost principle, is not these. Cost principle are the ones we record at cost. Going concern assumption. The going concern assumption, we assume that a business is going to continue in business indefinitely. There are times when you don't, and you have to make a lot of disclosures in the notes as to that. Okay. So basically, because of the going concern assumption, we don't revalue things to what we can sell them for. So if you think around your home, you would think of, just take a couch for instance, that the couch I paid $1,000 for my couch, even though it's only worth $50 today, because it's pretty old and subject to a lot of wear and tear, etc. We focus on it on the cost principle. Now maybe the couch was a bad example, because we would, in a business, we would depreciate that couch over its life, but we don't remeasure the assets to their resale value. We just value them on the financial statements at cost, and then we may depreciate them over their life. Objectivity principle, we value things that based on information that is factual, objective, and verifiable. That's why we would record things at historical cost, because we have an invoice for it that's verifiable. And objectivity is also one reason why we don't value human resources. So for instance, what is my value to Quincy University? What is, pick another instructor, what would they value them at? And notice that a lot of times what they pay us is dependent upon market rate, market wages for the position that we hold. It doesn't necessarily mean that's how much value I have to Quincy University, because maybe I serve on tons of committees and somebody else does other things. And again, the value, just because it cannot be objectively verified, we do not value human resources. Okay, the stable dollar assumption basically means we ignore inflation. So make sure you know those definitions, but in the financial statements, we ignore inflation. There are times in our history when inflation has been pretty high, and we have decided to have supplementary data as far as inflation, but we do not at this time. And notice that some countries like Mexico, they do adjust their financial statements, especially because they have prolonged inflation. And if that ever happened in the United States, we may change that. But right now, we ignore inflation. Okay, back up here to liabilities. Liabilities basically are things you owe. So any debts, anything that you owe. So they're claims against the borrower's assets. Those claims are usually cash, but we'll find out later that there can be other types of claims. You might not have a claim to cash. So know these definitions, but that's basically what a liability is. Owner's equity, later on we're going to go through the financial equation which is assets equals liabilities plus owner's equity. If I restate this, I can restate it mathematically as assets minus liabilities equals owner's equity. Okay? Everybody says accounting is math, but that's about as difficult as we get here. In this semester anyway. So basically think about this, but remember this is not perfect because our assets are recorded at cost, not what they're worth. So if I take my assets and I pay off my liabilities, everything left is this. So if I have $100 of assets and I only owe creditors $20, the owners have a claim to $80. So that's kind of what owner's equity is, a residual amount that's left over. Okay? So how do we get owner's equity to go up? The owners can put more cash in the business. So remember, there are two sources of owner's equity: capital stock and retained earnings. And decreases, you can pay cash out to the owners. We generally call those dividends, or you can have losses that decreases. So notice we have assets equals liabilities plus owner's equity. So if I took 360 minus 96, 264 is left for the owners. Okay, so we're going to now again, you're going to skip back and forth, but we're going to go through this. Let me pause. Okay, so you have this on your handout, so please fill that out as I go along. I'm going to show you here. I don't subtotal. Notice they have balances, 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 balances. I don't subtotal after every transaction. I kind of think that's a little bit of a waste of time. I don't remember what your homework has. I just tend to balance at the end. So we only have 10 transactions, but certainly the computer does this balancing for you. So if you feel better about it, you can put a balance line in it, but I just want you to put the transactions. So this is cash, accounts receivable, etc. So I want you to fill them in. And an important part here is this equal sign. So I would like you to draw a real thick line right down here. And notice this side has to equal that side. So we have an auto mechanic who is going to do certain transactions. All your transactions are up here. Since they're on the overhead slide, I'm not going to come up here. And also I'm going to just show here because the PowerPoint slide does it a little differently, but the PowerPoint slide has important information, but this is more like your homework. Okay. All right. So please read through these. Okay, so on January 1st, this is your first one up here. So please look at that. Hopefully you've printed them out like I asked you to. Okay, so on January 1st, Michael Bryan started Overnight Auto. He invests $80,000, received 8,000 shares of stock of $10 par. So we only record things in financial statements in dollar amounts. So this 8,000 shares of stock does not get entered, but 8,000 times 10 equals 80,000 does get entered. So you would note this someplace else, which we'll get into later. So what happens in the business? I asked myself, remember the business is a separate entity from Michael McBrien. So they're going to have their own records. And he now has a claim to the business, and the business has the cash. So in the end, if he went bankrupt or something, they have, unless this is a corporation, creditors will get this $80,000 cash. But for accounting purposes, He owns capital stock in the business, which owns $80,000. It's a separate legal entity. So up here, I'm going to put a positive $80,000 in cash and $80,000 in owner's equity, and it's an investment, so it goes under capital stock. So notice I equal. Over here, they're showing the balance sheet. So it's pretty much the same as this, but I like to write down this first because we're going to end up with the balance sheet down here. So notice we have assets and owner's equity, but this handout is good, or this is good because it's going to show us what happens to each of them. So they purchased land from the city for $52,000 cash. So notice that my cash goes down, so I'm going to put a negative So I'm going to put a negative $52,000 here and a positive $52,000 here. So notice this is my equal sign. So negative 52 plus 52, I've got a 0 over here and a 0 over here. So all I did was exchange one asset for another. And then the balance sheet over here shows the balances. So what I have left now is $28,000 cash, $52,000 in land. So notice I still have $80,000 of assets, and the owner has claims to all those assets, but now instead of cash, I've got two assets. Excuse me, I have got a cough. Okay, transaction 3, they purchased an old garage for $36,000. They paid $6,000 down and issued a 90-day note payable for the remaining. So always ask yourself, what did they get? They got an old garage worth $36,000. So over here on my asset side, I'm going to put plus $36,000 under building. You can call it garage if you want. They're your financial statements. You know, you can keep as much detail in different accounts as you want. These are just the accounts the business had. So certainly if they had a garage and office building, etc., you may see sub-accounts under building. But what did we get? We got $36,000 building. How did we get it? We got rid of cash, so I'm going to put a negative over cash. And I have a liability. I owe the other $30,000. So notice my assets are $30,000 and my liabilities are $30,000. So this side equals that side. And again, my financial statement shows what's left, the balance here. So I have $22,000 in cash. But notice here, my liabilities and owner's equity now are $110,000. So I have $110,000 worth of assets. Creditors have claims to $30,000 and I have claims to $80,000. Next one, they purchased tools and automotive repair for $13,008 on account due within 60 days. So ask yourself, what did the business get? The business got tools and equipment. So we've got tools and equipment here. It's going up by $13,800. And how did I get them? Well, you want to say I paid cash, but I didn't. I'm going to pay in 60 days. So I'm going to pay it in 60 days. So it's an account that is payable. You will always have accounts receivable or payable. Actually, people get these flipped, and hopefully if you do get them flipped, laugh at yourself a little bit, because you tend to pay bills, pay creditors, and receive from customers. So I'm paying this, so don't put it in accounts receivable. People don't give me tools and give me money for it. I pay the money. So I have my assets are $13,800, but I don't own it. So notice now my amount that the creditors have claims to of my $123,800 is $43,800, and $80,000 of is owners. Overnight realized that the company had purchased more tools than it needed. They sold some of the tools for $1,800, a price equal to its cost. And this is important, Ace agreed to pay the amount within 45 days. So in other words, I'm not getting cash. So most of the time we would like to go down here and increase cash, but we can't. So we got rid of $1,800 of tools and equipment, and somebody said they'd pay us later, so we're going to receive that money later, so it's accounts receivable. So notice tools and equipment goes down, accounts receivable goes up, this nets out to 0 over here, and so I have 0 over here. And again, the balance sheet shows the balances of what is due afterwards, what is left afterwards. So I still have $123,800 because I just flipped one asset for another asset. They pay overnight $600, so Ace pays. So sometimes just going back and figure out this is Ace. We were receiving money from Ace, and Ace pays us. So they pay us $600, so we got $600, and we got rid of, think of accounts receivable as a running total of the bills people owe us. So So they paid us $600, so now I have $1,200 left. So now I flipped one asset for another. I got cash in place of that accounts receivable. So this is 0 over here, and that's 0 over there. January 27th, we made partial payment. We are overnight. Again, in transactions in accounting, and I do it sometimes also. Sometimes you just step into the shoes of the wrong business. So we are overnight, not Snappy Tools. So sometimes you'll make the entry for Snappy Tools and you'll be right, but the question is for overnight. It's not really realistic because in the many, many years I've worked for companies, I've never forgotten who I worked for, so I wouldn't make the mistake of making the entry for the other company because I know I work for overnight. So again, it's not really realistic, but do spend some time thinking about who we are. All right, so we paid $6,800, so cash is going down for $6,800, and I'm also paying off my bill, so my running total of how much I owe people is going down. So I owed them $13,800 before, I paid off $6,800, so now I have $7,000 left. So notice this is the balance that's left on your finance balance sheet. So at all points in time, I can prepare a balance sheet for it. They recorded auto repair services for $2,200 received in cash. So remember, we are an auto repair service. So this is what we're in business for. And whenever we record what we're in business for, it's a revenue. So I want to put plus $2,200. Later on, we're not going to put this directly in retained earnings. We're going to keep track of it for a year. So please write next to this revenue. So retained earnings owner's equity has capital stock and retained earnings. Retained earnings will have revenues and expenses and withdrawals. So it'll have 3 things in it. So this is a revenue. So I got cash because I earned what I was in business for. And then I paid operating expenses of $1,400 in cash, so cash is going down. And this is an expense, is a cost of earning those revenues. So I'm going to put that under retained earnings, but make sure you write expense out to the side because you'll need that before we do the first exam in Chapter 3. So here we are right to this one. So hopefully right now this looks like that. Hopefully I put enough lines. But this last line should be the balance. If I didn't leave enough space, please write the balances underneath. So the only balance I'm concerned about is the very end one. So write the $16,600 for cash, $1,200 for accounts receivable. Write these along the bottom because those are important for later on. Okay, so we're going to look at this for the cash flow statement, and we're going to look at these two for the income statement, and then this bottom line is the balance sheet. So revenues. I believe if you go up here, you have some revenues. I did not put them. I would add those if I was you. What are revenues? Revenues are what we're in business for. So they are increases in assets from its profit directive activities. That's a long way of saying what we're in business for. So, and then expenses are a cost of doing that. Okay, so we know the basic income statement is revenues minus expenses. So we're going to prepare an income statement down here. The income statement just takes these 2 items right here. If I had more, I'd put more, but I don't. Our only revenue is $2,200. I list my expenses, and I have 2 expenses. I just list 1 expense because I didn't break those out for you. Okay, this is a little bit wrong here. So list operating expenses $1,400 and net income of $800. Okay, so this is pretty important. Investments by the owners are not included in the income statement. You can't put money in a business and say, hey, let's go to your lawn mowing business, and let's say I invested $1,000 to buy a lawnmower. You can't say, hey, I made $1,000 this year. Statement of cash flows. There's a whole chapter on the statement of cash flows, but statement of cash flows, investors and creditors want to know where is the money coming from. So it's divided into 3 sections: operating, investing, and financing. Operating is what we're in business for. For a lot of times, if our net income is cash, it's going to be these 2 items here because this is what I'm in business for. But we'll learn later It doesn't always have to be equal to net income, because sometimes I give customers the ability to pay later and therefore I don't get the cash yet. And sometimes I pay later so the cash doesn't go out yet. But it's effects of net income type transactions that will go into the operating section. Investing, think of investing activities as investing in my business to make it better. So I might buy a lawnmower, that would be an investing activity. If I cash, that would be a cash outflow. Cash inflow would be if I sell that lawnmower later on because I want to buy a better lawnmower or something. All that goes in investing activities. I'm investing in my business, and you can also invest in other people's businesses, such as, buying stock or something in another business. And financing activities are generally over here. I either finance something by borrowing money, or I finance something by getting it from the owners. So the transactions, I should say long-term liabilities, not short-term liabilities. So this would be I'm financing right here in my notes payable. This is not financing because this is more day-to-day operations that I would have, creditors, etc. So I finance with two ways, debt and equity. Okay, so look at the statement of cash flows. And so generally what I do go through here is I just usually go through these red items. Let me see if I can make it bigger. And I identify if they're an operating, investing, or financing activity, and I put O, I, or F beside it. Okay, so this $80,000 came from the business owners to invest in the business. That's how I finance. So I'm going to put a little F by it, and notice it's sale of capital stock goes down here in financing activities. So I have that down there. Then this $52,000, I purchased land. So cash is going out to purchase land, so I'm investing in my business, so that goes here under investing. Next one, I purchased a building for $36,000, but since this is the statement of cash flows, I look at the cash. I only paid $6,000 cash for that building, so that goes here. Later on, next year, when I pay off this note, we'll have the other items on there, but this $6,000 goes into purchase a building. Purchase of tools, oops, I should go down here. So now I've got financing, investing, purchase land, purchase building. Next one, skip these. If it's not in the cash, it doesn't affect the cash flows. The next one is this tools. And these tools that I purchased these tools or sold these tools that I bought extra. So notice that the purchase of the tools went in investing, so when I sold it, I get those in investing also. So notice there's purchase of the tools was $6,800. Okay, so my tools were $6,800. I was going to pay for them later. Okay. All right. So then, let's go back to that. Pause this. Okay. So look up here. They realized they had purchased more tools than needed, so they sold $1,800, and on the 26th they sold them. Ace Towing paid us $600, so that's this $600, and it has to do with the tools. And tools are part of what we use in our business, so we've invested in our business. The next one is the $6,800, where we actually purchased the tools. We actually paid for the tools. So let me back up here. Here's where we bought the tools. We bought the tools, we're going to pay for them later. It doesn't affect cash. Okay, and then we sold some of the extra tools here. We collected on the extra tools. Okay, but notice this doesn't affect cash because they're going to pay us later. Now they paid us, so we sold the extra tools. And here's where we paid off 68 of the 13.8. So later on, we're going to have a little bit more of that. So we have 68 of purchase of tools. Next one, plus 2,200. That's what we're in business for, so that goes in operating, and 1,400, that's what we're in business for, so that goes in operating. So basically write FIIO next to it, and then just plug it into the format of the cash flow statement. Okay, so here's your definitions that we've talked about. We'll read through those. Hopefully you've read it in your One thing I will say about a cash flow statement, it's really important that this one be positive, because this is what I'm in business for. So you want positive cash flows from what you're in business for. This one and this one, them being negative or positive is neither good nor bad, because notice cash flows go out the door if I purchase land and purchase buildings. So sometimes that indicates that I'm expanding. But other times I can expand by paying later because I have a great low interest rate. And so this being positive or negative is really not that important. Also, if I sell stock, that's going to be positive, but if I pay dividends, that's going to be negative, cash going out the door. If I repay loans, that's going to be negative. So again, these being positive or negative are not indicators of anything. But this one we generally want to see positive, the cash flow. And then notice I have cash balance at the beginning of the year. I started out with 0 on January 1st, and then I have my cash balance at the end of the year. So if I had a beginning cash up here, these two, it should all tie together. It's called articulation. These appear on the balance sheet. So down here, fill in, there's your cash flow statement. Looks like I might want to put it on this page. Fill in your balance sheet just with this bottom line here. And so notice that I have cash, accounts receivable, tools and equipment. So it's basically listing these headings with their ending balances, and on the other side my liabilities and owner's equity, and making sure this equals that. Sometimes you'll have a problem that won't give you retained earnings, so it won't be transactional, but they'll give you balances and you have to determine retained earnings. So notice if I have all of these, I know this is 117.8, so this has to be 117.8. So if I have everything but the retained earnings, I can back into it because I know this side has to be 117.8. Okay, we talked about this. That's a little chart I drew that we have a balance sheet, and then I have an income statement and cash flows that span the time. Articulation means they all tie together. So notice the cash flow agrees with the cash, and that the net income doesn't always come down here because it only works this year because it's the first year, but sometimes I have prior year retained earnings, and we'll talk about that later. Okay, so a couple other things up here on your handout: forms of businesses, sole proprietorship, one person, please read through and notice some more differences. Partnerships, 2 or more people. And then corporation, they are by law a separate entity, even though in accounting wise all of these forms of organization are separate entities. They're not separate legal entities, they're separate accounting entities. But a corporation is a separate legal entity, which means basically a lot of people incorporate because of that. So let's say that I had a tax business that the public came in. Well, whenever the public is involved in something, you could have somebody fall on your steps due to ice, and they could sue you. And if you form as a corporation, you could, if the legal system finds out you're at fault, you could lose your corporation, but you couldn't lose your home. If it was organized as sole proprietorship, you could lose your home. So a lot of businesses or people form their businesses as corporations just because of the safety net of, if I lose something due to something unforeseen happening in my business, I would not lose more than my business. Okay, so you can read through those. This is what the owner's equity section looks like for a sole proprietorship, partnership, corporation. Basically, they're pretty much the same, except capital stock is owned by thousands and thousands of people, so it would be pretty long financial statement if we have to list the names of all our shareholders, so we just group them together under capital stock. Liquidity and profitability. Liquidity is basically shown in the cash flow statement. Liquidity relates to, can I pay my bills as they come due? So it's generally related to cash flow. All of us have been not liquid at a time point in our life, and depending on how narrowly you define it, if you have ever gone someplace and forgot your wallet, and you have just eaten and you forgot your wallet and you ate with friends, you are not liquid because you do not have enough cash to pay your bills. So basically what you do is you borrow from your friends and you pay them back later. I also would like to add the term solvency here. Solvency is long-term, so liquidity is short-term. So I don't have my wallet with me, but I tell my friends, hey, I'll go home and get my wallet and pay you back tomorrow or pay you back later, et cetera, et cetera. I am not liquid at the moment, but I can pay my bills. Solvency is when I can't pay my bills, so that's more long-term. That's when I have fewer assets than debts outstanding, and that's what leads, solvency is what leads to bankruptcy. Profitability is basically how much money did I make this year. So I could make a lot of money on my income statement, but if nobody's paid me yet, I'm not liquid. Finally, okay, we'll talk about that. Finally, we have something very important in the world are the notes to the financial statements. So the numbers alone don't tell us everything we need. So we have the notes to the financial statement that tells us the details that we want to know. So for instance, on the balance sheet, you might have a loan outstanding. Well, the notes would tell us the interest rate of that loan, the length of the loan, because certainly a loan that of $1 million that's due in 10 days is viewed differently by creditors than a loan of $1 million that's due in 10 years. So that's what the notes do. So please read what adequate disclosure is. Here's some things they have to disclose. Significant accounting policies. You'll learn in this class that there are several ways to do things. Subsequent events, things that happen right after the balance sheet date, but that are important and before the financial statements get printed. Contingencies. Contingencies are things that are contingent upon the outcome of something. So if we have a lawsuit outstanding and we want to disclose that we have a lawsuit outstanding, but the amount we're going to lose is contingent upon the court settlement. Contractual commitments, so if I sign a long-term commitment to buy X amount of dollars of raw materials from a company over the next 5 years, I would disclose that in the notes. And the assets pledged as collateral. So if I have inventory that I've pledged as collateral for a loan, investors want to know that. Okay, so you can read through these, and that's it. So please practice these, and hopefully this helped.